Hi, everybody. This is Lance from ThetaTraders.com. This video, I'm going to look at a covered strangle strategy using possibly SCHD. SCHD has been just announced that they're going to do a 3-for-1 stock split. We're going to look at a possible covered strangle strategy. So let me go over what the strategy is and why SCHD might be a good one for it. All right. So recently, SCHD said that they're doing a 3-for-1 stock split. On SCHD right now, the current price is around $85 a share. So then we're going to be able to lower it for 3-for-1, meaning you're going to get 3 times more shares of stock. Just do a quick calculation here. You're at $85 a share and divided by 3. The share price will be pretty close to around $28 a share. So this makes it a lower cost to actually do options on the actual ETF. And also there might be more volume and open interest. We'll have to see on October 11th if that's actually true or not. So what is the covered strangle strategy? Do this quite a bit on MES futures. And I'm looking to do this now on SCHD in my Roth IRA account. So covered strangle is a combination of a covered call and a short put together. This is a slightly bullish strategy because you'd want the short put to expire worthless and for your covered call to get some premium. You should be okay with losing your 100 shares of the covered call, or if it just goes up a little bit, you might be able to take the full premium and then still hold your shares. You could increase your premiums received over a straight covered call because we're selling a short put as well. Now, we only want to use this with stocks or ETFs like SCHD or futures that you're willing to own for a long time. And you need to be willing to own at least 200 shares. One is the initial 100 shares you're going to own. You're selling a covered call against that. And then you're also selling a short put cash secured with the second 100 shares and being okay with getting a sign on that. You could also do this with futures into futures contracts with MES or ES. So how do you set it up? It's pretty straightforward. We're going to buy 100 shares of stock or ETF, sell a call. Now, where you sell your call could be a little bit in the money if you want a little bit of downside protection or a little bit more premium. You could sell at the money and then get a decent amount of premium as well. Or you could sell out of the money for possible capital gains. So if SCHD is at $28 a share and you sell, say, a 30 strike on the call side, you would make $200 in the capital gains from SCHD moving up from 28 to 30. And then you also want to sell a put. I'm going to look around 0.1 delta. I might be willing to go near expected move, 0.16 delta. Depends on what the premiums are on October 11th. Now, how do you profit? You're going to receive premium on the covered call and the short put. If the stock is flat, you receive your full premium on the covered call and the full premium on the short put. And if you set this up right, you can get a pretty decent return off it. SCHD doesn't have a ton of implied volatility, but it might be enough to actually make a pretty decent return. If the stock goes up, you're going to use your 100 shares that you own to cover the short call, and then you receive your full premium on the short put. The stock goes down, but still above your short put, you got your full premium on your covered call, full premium on the short put, and then you can just do that over and over again. So this is what I looked at recently for SCHD. With the current share price of around 84 or so dollars a share, the October 18th expiration, about 3 weeks from now, you could look to sell around the 82 or 83 strike price. For the 82 strike price, you might get around $25 to $30. And for the 83, you get a little more because it's a little bit more closer to in the money, a little less out of the money. Also on the call side, you sell at 86 or so covered call, you can make around $25 to $30 there as well. And by holding the stock, you could get dividends. And SCHD has a really good dividend growth rate. So when SCHD splits 3-to-1, the ETF price will be around 84 divided by 3, around $28. You're going to need around $2,700 because we're going to sell a little out of the money. And then times that by 2. So around $5,400 to do this strategy. And obviously you can scale up and do multiple contracts if you need to. Now, how are we going to manage it if the put is worthless and you still own the stock? Then we just sell another call. You can sell at the initial price or even higher, or sell and then sell another short put. So I currently own quite a bit of SCHD in my Roth IRA. I'm going to be doing this with only some of my shares. I'm not going to do it with all my shares because if it does run up quite a bit, you want to be able to get the capital gains on most of your shares. So if you found this video helpful, please leave a link in the description down below. I'll read and respond to all comments, and see you guys on the next one.